But to get back to the SEBI reforms, and that's the big talking point today. Vivek Kudva of Franklin Templeton joins us. Mr. Kudva, thanks a lot for joining us and joining us in our studios here. Is this, addressing the structural issues? Do you think we'll see additional inflows, particularly from retail, and will it make fundraising easier? Have the structural issues been addressed?
I think the changes announced by SEBI are all very positive, and I definitely think it will help all the three constituents, the asset management companies, the distribution companies, as well as the end investors. This, I would say, is the first phase in a series of reforms that are required. I think there are additional reforms and changes that are required, and I'm hopeful that along with the ministry, SEBI will usher in those changes over the next several months.
Mr. Kudva, good to see you in. We just had this conversation some time back with regards to what you all were expecting from the SEBI to come out with on the mutual fund industry. One of the things you spoke about that time was fungibility and the tweaking of the overall expense ratio. Just give us a sense in terms of what exactly would the fungibility norms mean with regards to overall expense ratio, and how is it going to help the mutual fund industry going forward?
Right. So the fungibility basically means that previously you had an expense ratio cap, and within that the management fees were also capped. Now what happens is that the expense ratio that is increased a little bit, but more importantly, within the expense ratio there is no cap on the management fee. So those asset management companies that are efficient, within the same expense ratio, they can get more management fees through that efficiency. So I think this will spur the entire industry to become more efficient.
You alluded to the fact that more is required. Do we need some more changes to attract inflows? What do you think should be done, and what SEBI is not yet addressed, which should be done very soon?
Yeah, I think one of the big issues the industry faces is that there is no long-term money coming into the industry. When I say long-term money, it is the mandatory savings of individuals. And there's no insurance money, because asset management companies or investment management companies in India cannot manage insurance money, right? So I think what needs to change is that investors should have a choice. Today, only voluntary savings go into EPFO, into NPS. All mandatory savings go into the EPF. Right. So firstly, I think investors should have the choice of either investing in the EPF or investing in the NPS or investing in a mutual fund that has the same regulatory, structure as a pension fund. Right. Once that happens, mandatory flows will come into the asset management to the investment management companies, and I think you will manage more money, and there will also be an element of stability, because mandatory savings are typically for 15, 20, 30 years. So I think that's the big structural change, one that needs to go.
Has that been put forward by you or the mutual fund industry to SEBI? What's been their response? Any hurdles that you believe could be? Yeah.
I think that requires the intervention of the government and the ministry. So we have placed our requirements with the ministry officials. We have informed them, but I think it has to be debated, because obviously there are several constituents. The EPF is involved, ministries are involved, and I'm sure several people, opinion makers, thought leaders would also like to comment on that. But definitely we've placed our request on that. And hopefully in the next few years, or at least partly this year, I hope, when the budget is announced, hopefully some of these measures will be, introduced.
Mr. Kudva, what are your thoughts with regards to this entire change on exit load? Is it going to be more beneficial for long-term investors? Can you just take us through the rationale and your thoughts on it?
Yeah, see, we, especially Franklin Templeton, we've always looked as an exit load as a mechanism to kind of guide investors to stay invested in our funds for a longer term, because the whole idea of investing, we believe, is long-term investing. So for us, the exit load, when people exited before the exit load period, was never a mechanism to make money out of it. So we welcome SEBI's move to actually credit the exit load back into the funds for the benefit of existing investors. Because often you find that when an investor leaves, especially large investors, when they leave before the exit load period, it creates some problems for the fund managers in managing the fund. If there's a huge, for example, on debt funds, for example, if there's a huge redemption that was not anticipated, then the debt markets are not very liquid. So when you sell that debt, there is a loss incurred. Who bears the loss? The investors who remain in the funds. So to the extent that the exit load goes back to the credit of the funds, I think it is for the benefit of existing investors, long-term investors who are staying in the funds. So I actually welcome that move.
What about the overall cost burden on an investor now? Because now the service tax goes to investors, etc. How much of an incremental increase do you see?
So the 20 basis points increased in TER, I think, is neutral because the exit load will be credited back for the benefit of investors. In the service tax is an additional expense. So that will, whatever is the management fees on that, maybe 10 basis points, 12 basis points. And in the smaller cities, as you get investors from smaller towns, obviously you can pay up to 30 basis points more if you get 30% of the investors from the city from cities outside the top 15. So that has an incremental cost of up to 30 basis points. But I would urge you and urge our investors and urge the public at large to look at it slightly differently. Okay, at the end of the day, it's maybe 30 basis points, 35 basis points incremental expense, right? But it's very transparent what we charge the mutual fund industry. Now think about it. When you buy fruits and vegetables, does it ever occur to you that the farmer gets 2 rupees, you pay 20 rupees? Property prices have gone up 5-fold in the last 10 years. Does anybody really say anything about it? For us, the expenses are going up effectively by 30-35 basis points. And even that, some of the expenses, for example, taxes, that's not something that we are getting. The taxes were always supposed to be borne by the end investor. Right?
But Mr. Kudva, given the fact that retail has already been out of the market for quite some time now, the markets have been very volatile. For them to impose an additional cost, do you think retail investors will try and make a comeback? Do you see them coming in the near term to invest in equities?
I think retail investors will come irrespective of the cost, because the costs are insignificant. If you look at the 10-year, 20, 15-year record of equity firms, many of them have given over 20% compounded. So another point, 25 basis points is not significant. There are 2 requirements for an investor to come back. One is the general state of the economy, optimism, the business environment. I think that is an issue now. There have been concerns about the general business environment, right? Secondly, tax benefits. The biggest driver, one of the big drivers of investments in mutual funds, because mutual funds are subject to market risks, right? And you, on the other side, you have bank deposits giving you 8-9%. You have, the small savings schemes giving you 7-8%, 8%. You have tax-free bonds giving you, 8%. We are competing against that, right? So if you have the right tax incentives, then you can draw investors into mutual funds. And I actually believe, so that's the second structural reform. One is about long-term investments in pension and insurance companies, that to be managed by the investment management companies. And the second is, I think the government needs to create a long-term investment scheme whereby when you say up to 5 lakhs per annum, where if at the time you invest, you save tax, returns on that investment get taxed as per DTC normal rules. But when you withdraw that money, you then pay tax on it. It's only a tax deferral, right? It's not, so the government, yes, it loses current revenues, but it subsequently it gets those revenues back. But that can be a huge driver of flows into the mutual fund industry. So I think the second structural reform, I think, is to create those long-term investment plans, maybe with a 5-year lock-in. And this will also help, people save money for, certain events, children's education, marriage, which are all, are big expenses these days.
Absolutely.
And I think there has to be some tax incentive.
I think these are structural issues that the regulators must look at, and if they're listening to Mr. Kudva. But getting back to the markets, Mr. Kudva, how do you play as a retail investor? I mean, Indian macro is looking very bad. Globally, there is some stability, fund flows coming in. How do you play, or how do you allocate your portfolio? Do you still put some amount in debt funds, or should you go venture into equities at this point?
Actually, just to add to that point, there was an article in the newspaper today that there's a significant reduction in terms of FMP investments as well. Just give us a sense, is the lure of debt coming off?
I don't think so. I still think that, debt schemes of mutual funds are probably on a post-tax basis, probably the best for a retail investor, I think, because you can get indexed, you can index your gains before paying taxes. So I think it's still very good. I personally believe that debt funds will continue not only survive, but they'll thrive, and I feel that if an investor is not allocating a reasonable portion of their savings to debt funds, they're making actually a big mistake. So that's the first. As far as equity investment goes, I know that there is a little bit of pessimism about the state of affairs in India and in the markets. But let me give you a perspective. I traveled to several countries, in my role as managing director for Central Eastern Europe, Middle East, and Africa. And India still has probably the best growth of most of those countries. We are crying because growth is 6%, and I think 6% is not enough to meet the aspirations of the people of India. We need maybe somewhere between 8 to 10%. But 6% is a lot better than 0% or negative growth. So I would say that yes, there are difficult times, but even if you have 6% GDP growth, corporate earnings should be able to grow at maybe 12 to 15%.
Mr. Kudva, the FM is actually listening to you, and he's given out statements. He's made statements that SEBI, he's happy with what the SEBI has done, but they're looking at more measures to boost the mutual fund industry.
One of the particular statements which have come out is that they don't mind, or they would look to allow MFs to invest in the Rajiv Gandhi equity scheme soon. What would your thoughts be on that?
So
it's a recommendation.
So obviously that's a step in the right direction. I think the Rajiv Gandhi scheme was is a good scheme, but I think getting first-time investors to invest directly in equities is a recipe for disaster, frankly. And the only way that should be implemented, in my view, is through mutual fund schemes, so they can get a diversified exposure to equities. I would make one other point is that it's for first-time investors. It's hard to actually monitor who's a first-time investor. 50,000 is not a lot of money in these days, so the government should withdraw that restriction and allow investors to invest 50% without having to do that check. And secondly, I think we should do 50,000 rupees per year, not one time.
Yeah.
Right? Because just if you invest 50,000 one time, you don't really get a flavor for the markets. When you invest regularly over a period of time, that's when you really appreciate what are the rewards and what are the risks associated for a market. So the best way to do it would be into mutual funds through SIPs across several years, for which the 50,000 limit has to be a recurring annual limit.
All right, Mr. Kudva.
One question before we let Mr. Kudva go. From a sophisticated investor perspective, where do you stand on the growth, defensives versus cyclicals debate? Do you think it's a good point to enter into the cheaper cyclicals? And the other, we've had a very decent rally. Would you look to raise your cash levels at this point, take some partial profits off the table?
The way we manage our funds is not to really take big cash calls, because the people invest in equity funds because that is their asset allocation that their advisors have made with them. So it's up to the advisor jointly with the investor to decide whether that asset allocation is right or needs to be changed. We don't take significant cash calls. Our cash is typically in the 5 to 7% range, and that's what we intend keeping it.
All right, Mr. Kudva, we'll leave it at that. Thanks very much for joining in. Probably have a conversation with you in the next 2 weeks, considering that these suggestions could possibly be taken up by the SEBI early September. But stable for the markets at this point in time.